it off to the side because I think Drew's onto something. Let's get this guy on the show. And, kudos to you because at least in the short term, you called a short-term top in these AI stocks and various tech names. But what are some of the warning signs you continue to see in this space? You talk a little bit about in your note. I know we've seen a sell-off in the space a little bit, so maybe that euphoria has died off some, but I imagine you're still seeing warning signs out there.
Yeah, so I'll give you the simple warning signs. It's when price moves really, really, really fast, and you hear from a lot of people, again, qualitatively anyways, that I have to own these names, I have to be in these names. I have risk if I don't buy this. So those are some really simple warning signs. But from my perspective, sticking to a more fundamental approach, it's when that price moves so much faster than we humans think the fundamentals are going to improve. So honestly, structurally, we like AI. We do think it's a game changer. It's one of our top themes, but it's how you want to invest in it when you get these wild, crazy upside price moves. Because honestly, greed, that much greed is probably not good when you're playing around in this space.
Yeah, I don't care what Gordon Gekko says. Sometimes greed is not good. I mean, look, Drew, as a strategist, how hard is it to come out with a call or analysis like that when, to your point, everybody's saying, oh my God, I have to own Nvidia. My whole net worth needs to be tied up in Nvidia and these 12 other AI stocks. I imagine you don't put a note out like that lightly.
No, you got to stick to your guns a little bit. And honestly, we've had this framework for over a year that we've been building out because we actually don't think it's right to just sell stocks that could be transformative just because they have some high traditional valuation metric. To be honest with you, that's how you miss really good investments. If you say, oh, this stock has a PE over 20, 25, I can't own it, that's wrong. But at the same time, if a stock is trading at a point where the market's pricing in 40, 50% growth, and when you really look at it, okay, maybe 25, 30% is realistic, then you gotta take some gains, you gotta trim something back. So it's not like you can't buy these stocks at certain times. It's just, don't be over concentrated in them. Like it's boring. It's not fun to talk to people about risk management on single names that are in every headline.
It's fun to me, Drew. It's fun to me. It's very sexy to me. All right, keep going.
Yeah.
Keep going.
But no, just it is boring. You do get a lot of pushback. You get labeled as this big bear, and you're just kind of sitting here. It's not if, it's kind of when. When do you want to own these stocks, and when do you want to have a lot of them?
Tell me if you agree with me, or I'm off. I get the sense when it comes to AI, most investors have no clue what these companies do, and they really don't know why they're buying these stocks. Just because, if anything, maybe their neighbor is buying these stocks.
Yeah, I think a little bit of that is true. In the professional community, this sounds weird, but I don't think people on the buy side and even some of the sell siders that cover these industries really know what these companies are going to look like in 5 years. We can talk about whatever chip they have today and whatever their product they're trying to train and do in this instance, but the market's pricing out what that company is going to become. And I think that's difficult. So Main Street might not know exactly what they do. And I can tell you right now, Wall Street probably doesn't know what these things are going to become.
That's absolutely terrifying. So what happens next?
Yeah, look, I think what we're seeing right now is really, really healthy. Those big names, the big winners, the Nvidias, the TSMCs, the Microsofts of the world have this pullback to get you closer to reality. I think that's step one. And then step two, it's almost happened at the same time. It's the smaller companies, like I'll give you a couple semiconductor names, Teradyne and MKSI Instruments. Those stocks are actually holding up pretty well. So to me, you see a broadening of AI because it can't just be one or two names that win for this to be the next big thing. This has to pull along way more stocks, way more types of companies. So we're starting to see that. I think that's really important in the AI rally.
Has some form of bubble burst, and of course leave it to a journalist to try to predict or talk about some doom and gloom, or is this just the start of something more of a rout in AI stocks. The time where, let's say, Nvidia reports in a couple weeks, they blow it away on earnings, give upbeat guidance, and the stock doesn't react like the past 3 Nvidia quarters.
Yeah, see, I'm not sure we're at bubble yet. I'm a little hesitant to use that word just because the big difference between now and the tech bubble is exactly what you said. Nvidia is beating earnings. It actually has earnings. That's a good starting point. And then number 2, it's raising guidance. To me, the concern and when this becomes a real rout is when those types of stocks beat and don't raise. Because our work tells us that those companies need both. They need to beat and raise, and they need to do it for the next couple years, to be honest with you. So the rout comes when both don't happen at the same time.
You think we're nearing that point? I look at companies that have reported over the past 2 months that have positioned themselves as beneficiaries of AI. Salesforce, I mean, the stock got clobbered. They didn't necessarily come out with a great quarter and upbeat guidance. I mean, do you think we're right on the cusp of a Microsoft or an Apple coming out here and potentially, let's say they do beat by a couple pennies, but they try to temper that AI enthusiasm?
Not yet. I think it's kind of the rest of the market that's doing the beat and temper expectations, basically your old playbook for CEOs and CFOs. I do think the AI companies are trying to be pretty clear about the long-term opportunities. So right now, I would say for the next few quarters, we're pretty constructive on the fundamentals, especially of the Mag 7 and the early AI winners.
How does a common investor, let's say a retail investor, how do they know or how can they spot that the tech sell-off is nearing end? What key indicators are you watching?
To me, I'm really watching what the Nasdaq versus the Russell does. I think some gauge of mega cap growth. If you start to see that, let's say stabilizing or the market broadening, almost like it has in the last few days, where it's not very aggressive, different directional moves. Like, oh, Russell went way up, Nasdaq went way down. I think that's kind of a sign that, man, there's a lot of aggressive positioning changes. That this is going to be pretty volatile. When you start to see days almost like you did on Friday, where everything is up similar amounts with more subtle differences in returns, I think you start to get to a healthier point of positioning and you can get more comfortable with some of the large cap growth names.
So I was reading your note, Drew, and I wrote this down. Fake AI plays ? Tesla. And I think you didn't call them fake AI plays, but I think you make a really good point. There are a lot of companies out there saying they are playing in the AI sphere. Retailers, suddenly we're now some form of AI company, and even tech companies for that matter, saying they're AI, but there's no clear path to making money off this stuff. Well, I look at Tesla. I think Elon Musk is trying to pitch his company as an AI company. Is that an AI company?
Well, something like autonomous driving is more than what a computer can really do today. So maybe not AI in the sense that it's generative AI, like you see with what Microsoft is trying to produce. But yeah, I do think some of the auto companies have different application of this. So to us, instead of listening to what a CEO says, we're going to talk to our industry experts in-house and ask them, is this real? And they make that judgment. So that's the basis we're working off of. I hate to say this, but don't just trust a C-suite that's trying to use buzzwords. Look, everyone probably does this at times, but really dig in. Like, is this an actual component of their product? It doesn't have to be their whole business, because AI users, maybe someone it's not their entire business, but someone that can use the technology to get better. Yeah, that's fair. It could be an AI play. It's just not your clear, high exposure pure play.
Drew, I hear this crap all the time on earnings calls, especially over the past 2 years. We will benefit from our AI product suite that will lift ROI and improve ROA. I mean, it's a lot of smoke and mirrors, but how can investors spot that these executives are blowing smoke in their face? I mean, because it sounds real sexy on an earnings call, but I guess it just boils down to paying close attention to the bottom line. Is it as simple as that?
Yeah, actually, it's twofold. Pay attention to the top line, because the way I think about it, outside of the companies that are directly making money on AI, if they talk about AI changing their product suite, they should be talking about either my average selling price for my goods, my retention rate on subscriptions, my sales forecast should be better. And then number two, if they're talking about AI and how it's going to change the back end of their business, they should be talking about better margins and better efficiencies. So take the buzzword and then look for what the fundamental story is actually supposed to be. So look for the impact in fundamentals. That's what we're doing.
Are you seeing similarities between this current AI cycle and the internet bubble?
A little bit in how some of the price action has moved. Again, they're not straight lines up and to the right. They're these parabolic types of curves that, again, you should take profits when those moves happen. And then a little bit in some of the options activity. Like right now, people are being very aggressive with calls more so than puts. So you see some funkiness there. But again, the big dissimilarity, back to what we were talking about before, is there's actually earnings and fundamentals to talk about here.
Oh, what?
That was not
Pets.com
the
didn't
case
have
in the tech
earnings?
bubble.
Pets.com had no earnings, right? No earnings for Pets.com.
Well, and a lot of those IPOs back in the tech bubble were just like selling to each other on paper using IPO money back and forth. Like these are real companies generating real dollars. Like let's be real there. So, there's dissimilarity. That dissimilarity alone is really important to us.
Why do you still like AI? It sounds like maybe you're short-term, concerned about the valuations, but I mean, so longer term, you view AI, this is as big as
important one. We human beings don't move as fast as markets sometimes want us to. I do think this changes businesses because every business right now is looking for productivity gains. And I think that's what sets apart the US economy from a lot of other economies in the world. I think that sets the S&P 500 apart from smaller private businesses out there. And I think AI is going to clean up some low-hanging fruit. And then some of the other artificial intelligence, the old AI and robotics and stuff like that, I think that helps improve American manufacturing in some traditional businesses. So yeah, I'm long US companies, I'm long US fundamentals, I'm long productivity, and I think AI, robotics, and automation tools all play into that.
Well said. All right, hang with us, Drew. We're going to go.
I think we're not spinning how do you find the winning trade off of either potential president. It's what are the risks? Right now, I just feel like people are looking for the way to make a quick buck. And again, back to it's not fun to talk about, but I do think there's risks on both sides. And I hate to be completely neutral. I'm not trying to punt this one, but the Dems bring up tax risk and what that's going to do for businesses and growth. And the Republicans bring in tariff risk, which disrupts a lot of the multinationals that are heavy weights in the S&P 500. So it's kind of two-sided risk. It doesn't feel like either party is really great for markets.
What's the biggest risk, Drew?
Taxes get us nervous. But right now, when you look at the polls and the potential, I don't think a Dem sweep is likely. I think you're more if the Dems win or take the presidency, you probably have some mixed house, so it waters things down. I get a little bit more worried that tariffs, while they may not be as aggressive as an impact completely across the board, that the Republicans have a higher likelihood of getting all three houses and pushing some of that agenda through. So tariffs, it's a funny one. It's really hard to measure. And I think that's why people can't really hedge it or trade it ahead of time.
Is the taxes issue lose-lose? And hang with me here, because let's say Democrats stay in the White House. Those Trump tax cuts are going to roll off. But if President Trump does get back into the White House, isn't it going to be hard for him to push through more tax cuts given where deficits are in this country? And perhaps he can't extend all those tax cuts, which could be a risk to markets.
That's the offset. When people talk about, they'll extend the tax cuts, Yeah, they probably do. But then, you need the revenue side for the government to get kicked in. So that's when the tariffs come into play. That's the concern to me. If you don't extend all the tax cuts, it's a mild negative. I think tariffs get a little bit more disruptive if they get put in aggressively right away. And then honestly, you're kind of touching on this point. We can get into it more, but the thing that keeps us up at night is no one wants to address deficits. Like, let's be real.
Well, everybody wants to put it. I'm not getting Social Security because of them. I mean, let's be honest, Drew. I mean, I'm still a young guy, but I mean, this is not going to be around because of all these deficits.
And no one's going to do anything about this until they see the problem coming immediately before their next election cycle. Mm-hmm. So like this, here's the problem. What are we going to do? Are we going to raise taxes? Are we going to cut spending? What are we going to do? And everyone just says, no, next question. So I think, again, back to investors want to look for the trades for the Dems or the Republicans and talk about economics and what it means for markets. And they just go, let's talk about social issues. Mm-hmm. Let's talk about immigration. Let's talk about different things that is not the biggest concern, how to deal with the deficit.
Well, let's stay on the deficits. Are we at that point? You know, it seems like people have talked to me about this for the past 21 years of my career in finance and journalism. Oh, deficits are a problem. They're going to keep going up, but the dollar is still the world's reserve currency. We still have a lot of trust in treasuries. But are we at that point where we can't trust these things? And then if so, what triggers a rout in the dollar? What triggers less concern in treasuries? What's that moment of truth?
Yeah, this is interesting because right now you still have good economic growth. So you feel okay about businesses. You feel okay about maybe not every individual, but the economy and individuals as a whole. And look, you just got to be aware of where rates are. So I think some of the work we've done around the budget, CBO's projections and so on, with rates at 4% and maybe a 3 handle, you feel okay, but you get back to a 5 or 6 handle, then you start to get nervous. So watching where the 10-year is I think a really good starting point for, the retail and a fun one to talk about it in-house later. But they do see a recession starting at the end of this year, a mild one to say the least. But what's different this time, always dangerous words, especially to say on a podcast, is you had the industrial recession coming out of COVID. So while the consumer might weaken, I don't think there's a bunch of businesses that are aggressively over inventoried and have all this excess buildup that they're going to get stuck with. So we feel a little bit better about bigger businesses and publicly traded companies. But yeah, there's some stuff on the fringes, but I think markets got ahead of it because honestly, they haven't traded up small caps. They haven't traded up consumer stocks. They haven't traded up anything outside of large caps. So markets kind of priced in a little bit of weakness. So, even if we have softness, I don't think those are the worst stocks to start thinking about right now.
I was talking to one of my good longtime CEO contacts last week, Drew, Whirlpool CEO Mark Bitzer, really just a top executive, gives it to us straight. And he told me he is really looking forward to that first rate cut so mortgage rates can go down. Of course, people start to buy more homes, you remodel your homes, you buy more appliances. I get it. But are you excited about that first rate cut? Because the way I see it, the Fed is not going to come out and cut rates if they see great economic times ahead. Chances are they would cut it in the fall because they fear that growth is slowing down.
Yeah, you're getting to the meat of this. It's not either or. It's not, do you need the Fed or do you need economic data? I think you need both. Look, I don't think we're going to have an acceleration in economic data. That's not worked into our models. That's not worked into our economics team's models. So yes, the Fed cuts, they probably come with softer data, but is it negative data? That's the kicker. Mm-hmm. If data stays positive, even if it's slower growth, I think that's really, really healthy for equity markets.
Do you think the markets will cheer? So the Fed comes out, I think it was the September meeting, maybe they signal out this at Jackson Hole in late August. September, first rate cut. What is that market reaction the morning after, you think?
I think we're starting to price that in now, to be honest with you. If you get that first rate cut, the economic data stays positive, you're going to see small cap, you're going to see the other 493 all contribute. I think that's really positive. To us, that perfect soft landing scenario is how, and probably the only way, you get S&P to 6,000 by year end this year. You're more likely to get more aggressive Fed cuts if the economy is weakening. In that case, you're not going to have a broad market. You're going to have volatility. But again, soft landing, it's both. It's not either or. If you get good data, positive data, and the Fed cutting, that's how this market rips higher from here.
In the couple minutes we have left, Drew, how are you getting questions already from clients on how they should be positioned into year end? And if so, what are you telling them?
Yeah, so right now, back to what we talked about top of the show. Take your profits in your AI winners right now. I think it's a good time to bank some of that in tech, in communication services. We want to get ahead of a Fed pivot. So we're talking about financials and we're talking about consumer discretionary. This debate we're having, is the consumer healthy? Is the economy healthy? If it holds up, those types of stocks tactically can work into the end of the year. And then on the other side, it's the defensive stocks. If the economy really weakens, if growth isn't there, people are going back to the Mag 7. They're not going back to consumer staples. They're not going back to the safer materials plays. They're not going back to healthcare. So I think healthcare materials are really good underweights.
Drew, I'm worried about the consumer. We have a couple of seconds left. I drive past the Chipotle, and you're looking at a $15 bowl.